Picture a normal Tuesday morning on Wall Street. Traders sip coffee, scan their screens, and wait for the opening bell. Then at exactly 10 a.m., everything changed. A San Francisco AI company dropped a product update. Within 60 minutes, $285 billion vanished. February 3, 2026. That is the date. Anthropic, the company behind AI assistant Claude, just released a set of plugins. These plugins allowed AI agents to do something new. They could log into business software on their own. They could review legal contracts. They could manage sales pipelines and conduct audits. No human required. The reaction was immediate and violent. Thomson Reuters, the legal data giant, plunged 16%. That was its worst single day in history. LegalZoom collapsed by 20%. London Stock Exchange Group dropped 13%. Software companies across every sector got crushed. Traders at Jefferies gave the carnage a name. They called it the SaaSpocalypse, an apocalypse for software companies. One trader described the mood in 5 words: "Get me out style selling." But here is the thing. This was not just one bad day. The software sector had been sliding for months. The Anthropic release was a match thrown onto dry kindling. It forced investors to confront a question they had been avoiding. What happens when AI does not just help workers use software, but replaces the need for the software altogether? To understand why that question terrified Wall Street, you first need to understand how the software business actually works. For the past 20 years, software companies have enjoyed one of the most profitable business models ever invented. It is called software as a service, or SaaS. The concept is elegant. Instead of buying software once, companies pay a monthly subscription. And the price depends on how many employees use it. That is called per-seat licensing. Think of it like a gym membership for every worker. 10 employees using Salesforce. That is 10 subscriptions. Hire 50 more people. That is 50 more subscriptions. Revenue grows automatically as your client's company grows. The money is predictable, recurring, and enormously profitable. This model turned companies into giants. Salesforce built a $200 billion empire on it. Adobe, ServiceNow, and Workday followed the same playbook. Wall Street loved these stocks. Predictable revenue meant predictable growth. Predictable growth meant sky-high valuations. But the model has a hidden weakness. It depends entirely on humans being in the loop. The per-seat price assumes a human being is sitting at a desk, logging in, clicking through menus, and doing work. Remove the human and the math breaks. Now imagine an AI agent that can do the work of 5 people. A company that once needed 50 Salesforce licenses suddenly needs 10. Or maybe 5. Maybe even none. The software did not get worse. The customer just does not need as many seats. This is not a theoretical problem anymore. Companies spend about $3,500 per employee on SaaS annually. Many of those licenses are barely used. Companies already wanted to cut software spending before AI entered the picture. Now they have a reason and a tool to do it. Publicist Sapient reported cutting SaaS licenses by roughly 50%. They replaced them with generative AI tools. When that story circulates on Wall Street, portfolio managers start doing very simple math. And the numbers they come up with are terrifying. The scale of destruction in software stocks is staggering. The numbers tell a grim story. The iShares Software ETF fell over 21%. That happened in just 5 weeks. $1 trillion in total market value disappeared. Adobe dropped more than 30% from its recent peak. It was once a Wall Street darling. ServiceNow fell more than 20%. It had beaten earnings expectations 9 quarters in a row. DocuSign and Intuit each lost over 30%. Asana collapsed to 92% below its all-time high. Microsoft shed $360 billion in a single day. That is roughly the size of Denmark's entire economy. Hedge funds smelled blood and piled on. Short sellers profit when stocks fall. They made $24 billion betting against software. And they were increasing their bets. Data firm S3 Partners revealed the extent of the damage. Over 35% of some companies' shares were shorted. One analyst at D.A. Davidson put it simply: every hedge fund is net short software right now. They are targeting companies that provide basic automation services. The logic is straightforward. If AI can replicate your product, your stock is a falling knife. But the damage did not stop at software companies. On Tuesday, February 3rd, something unexpected happened. Stocks of private credit firms started plunging too. Blue Owl, TPG, Ares Management, and KKR all dropped by double digits. Apollo Global fell 7%. Even BlackRock lost 5%. Why would lenders crash alongside software companies? The answer reveals the hidden risk that could turn a tech sell-off into something much worse. Here is where the story gets genuinely scary. Over the past decade, private credit firms became the dominant lenders to mid-sized technology companies. After the 2008 financial crisis, banks pulled back. Private credit rushed in to fill the gap. These firms now manage trillions of dollars. And they have a massive concentration problem. UBS analysts ran the numbers. Up to 35% of private credit faces AI risk. Software makes up about 20% of outstanding loans. Think about what that means. These lenders gave billions of dollars to software companies, valuing them based on predictable recurring subscription revenue. That recurring revenue is exactly what AI threatens to shrink. If software companies lose customers or are forced to slash prices, they may struggle to repay their loans. UBS estimates default rates could hit 13%. The current rate is under 2%. That would be a six-fold increase. The contagion channels are deeply concerning. About $40 billion in private credit overlaps public loans. Technology is the heaviest concentration. If private lenders start marking down their software portfolios, it could trigger a cascade. Redemptions from investors could force fire sales. Fire sales would push down prices further. Lower prices would trigger more redemptions. Financial analyst Jeffrey Gundlach has warned that private credit may be the top candidate to start the next financial crisis. JP Morgan's Jamie Dimon used the cockroach analogy. When you find one problem, more are usually nearby. The parallel to 2008 is uncomfortable. Back then, subprime mortgages were the hidden risk embedded throughout the financial system. Today, it might be software loans. The assets are different, but the structure is familiar. Opacity, concentration, and leverage are the same ingredients that made the last crisis so devastating. Not everyone believes the sky is falling. Bank of America fired back with a sharp rebuttal. Their senior analyst, Vivek Arya, pointed out a logical contradiction in the market's panic. Investors, he argued, are simultaneously believing two things that cannot both be true. First, that AI spending will collapse because companies are not seeing returns on their investment. Second, that AI will be so powerful it will make all existing software obsolete. Both fears cannot be correct at the same time. If AI is failing to deliver results, it will not replace software. If AI is powerful enough to replace software, then AI spending is justified. The market cannot have it both ways. Arya called the sell-off internally inconsistent. He compared it to the DeepSeek panic a year earlier. That sell-off turned out to be overblown. NVIDIA CEO Jensen Huang also pushed back. He called the idea that AI would replace the software industry the most illogical thing in the world. AI will use existing software, he argued, not replace it. SaaS founder Jason Lemkin offered a more nuanced view. He agrees the crash is real. But he argues it is not caused by AI killing SaaS companies overnight. Nobody, he wrote, is building a homegrown CRM in a weekend to replace Salesforce. SaaS growth rates have been declining every quarter since 2021. The AI narrative just gave the market permission to reprice. Bank of America also highlighted specific companies with strong defensive positions. SAP, with its deep enterprise integration and proprietary data, is harder to displace than simpler tools. The firms most at risk are those selling basic automation. Mission-critical platforms with complex data relationships have genuine moats. In 2016, software stocks crashed too. LinkedIn dropped 44% in a single day. Tableau fell 49%. The sector recovered within months. Microsoft bought LinkedIn 4 months later. But there is a crucial difference between 2016 and today. Back then, investors questioned the price of software stocks. In 2026, they question whether the products are still relevant. History offers some uncomfortable parallels. In the early 2000s, newspaper executives scoffed at the internet. Classified ad revenue was too sticky, they said. Readers were too loyal. The relationships were too deep. Then Craigslist launched. Within a decade, newspapers lost 70% of ad revenue. Department stores told a similar story. Retail was about the experience. People wanted to touch products. Online shopping would remain a niche. Amazon proved them wrong. Slowly at first, then all at once. The software industry may be facing its own Craigslist moment. Not every company will disappear. Walmart survived Amazon. Some newspapers still thrive. But the industry will look very different in 5 years. The companies that survive will be those with deep integration into business processes. They will own complex data relationships that AI cannot easily replicate. They will shift from charging for access to charging for outcomes. The price of software will reflect the value it delivers, not the number of humans who log in. The companies that fail will be those selling simple automation. Document processing, basic data lookup, routine workflow management. These are exactly the tasks that AI agents handle well today. Meanwhile, the private credit risk lingers like an undetonated bomb. If software companies start defaulting on loans at higher rates, the ripple effects could spread widely. Pension funds, insurance companies, and retail investors have all poured money into private credit. They could all feel the pain. Tech giants plan to spend $470 billion on AI. That money has to come from somewhere. Much of it will come from enterprise software budgets. Every dollar that goes to AI infrastructure is a dollar not going to another Salesforce seat. So here is the question worth sitting with. If AI handles your software tasks better, faster, and cheaper, what exactly are you paying the software company for? For more economics, business, and finance, minus the boring parts, check out our other videos.